Okay, let's jump right into this fascinating shift in global finance. We are looking at how a purely digital asset is suddenly challenging the absolute oldest store of value in human history. Welcome to this explainer on Digital Gold Awakens, why Bitcoin is becoming the new reserve asset. We're going to be unpacking a mountain of recent economic research, institutional investment theses, and even sovereign policy documents to figure out how a decentralized currency born on the internet is literally being weighed against physical gold. It's a massive macroeconomic transition, and we're going to look at the data totally objectively to see what the future actually holds for global reserve.
To wrap our heads around this shift, we'll follow this roadmap. Number 1, traditional safe haven assets. 2, enter the digital challenger. 3, comparing Bitcoin and gold. 4, the institutional tipping point. 5, sovereign strategic reserves. And finally, 6, between promise and reality.
Section 1. Traditional safe haven assets.
Right, so before we can really understand the disruptor, we need to establish our baseline. Why does the world even rely on traditional safe havens? The crucial takeaway here is that a reserve asset is basically a giant insurance policy against your everyday fiat currency losing its value, especially when a crisis hits. To put things into perspective, central banks currently hold a staggering $12.3 trillion in foreign exchange reserves. They use these massive stockpiles to pay for imports, stabilize their own national currencies, and basically cushion the blow from sudden economic shocks. When traditional markets stumble, or when money printers go into overdrive causing inflation, nations and big investors desperately need a completely reliable place to park their wealth so it doesn't lose its purchasing power over time.
And for centuries, gold has been the undisputed king of this space. Right now, central banks are sitting on about $2.2 trillion worth of it as a strategic reserve. But why gold? Well, it comes down to its unique physical traits. It's a rare metal. Pulling it out of the earth requires immense physical effort, highly specialized labor, and incredibly expensive equipment. That built-in difficulty, plus the fact that there's only so much of it in the ground, guarantees its scarcity. So for thousands of years, this tangible asset has offered historically low volatility and acted as a rock-solid shield against inflation and wobbly financial markets.
Moving on to Section 2. Enter the digital challenger. To see how a decentralized tech actually tries to replicate gold's historic utility, we have to rewind to the global financial crisis of 2008. Back then, trust in the traditional banking system was, well, pretty much shattered by bank collapses and government bailouts. Right in the middle of all that chaos, an entity known as Satoshi Nakamoto introduced Bitcoin to operate entirely outside of that traditional banking system. It completely cuts out the need for a trusted third party. Instead, it uses what's called a proof-of-work mechanism. Just like the Industrial Revolution relied on physical work, this modern asset inherently connects the consumption of electricity to the creation of a digital store of value.
Now, this number right here is absolutely crucial, 21 million. Unlike fiat currencies that central banks can just print endlessly, Bitcoin has an unforgeable digital scarcity permanently capped at exactly 21 million coins. That limit is hard-coded directly into its protocol. And that gives the asset some serious deflationary properties. If demand goes up over time, while the supply stays absolutely fixed, the price tends to rise. Very much like how gold holds its value simply because there's a limited physical supply in the Earth's crust.
Because of these foundational characteristics, absolutely no central party gets to control its monetary policy. The rate at which new coins are produced actually decreases over time through a process called halving, where the reward from mining is literally cut in half about every 4 years. On top of that, it runs on a leaderless network of decentralized nodes that all independently verify the ledger. And honestly, it brilliantly solves some major historical problems that plague physical assets, like counterfeiting. The list of fake substitutes for physical gold is super long, things like pyrite or gold-plated tungsten. Bitcoin, on the other hand, is entirely self-authenticating. The exact same electrical energy used to mint the coins also validates every single transaction on an unalterable public registry.
Section 3. Comparing Bitcoin and gold. Let's put them head to head. This perfectly illustrates the trade-offs between the two. Gold is tangible. You can physically touch it, wear it as jewelry, or lock it in a vault. But moving it around, that requires heavy logistics, armored trucks, and massive insurance policies. Plus, you can't exactly shave off a tiny piece of a gold bar to buy a cup of coffee. Bitcoin, in contrast, is purely digital. You can send it instantly across the globe with zero physical logistics. And it's incredibly divisible. One single Bitcoin breaks down into 100 million smaller units called Satoshis. But that digital nature brings its own unique risks, like cybersecurity threats or the very real danger of completely losing your funds if you just happen to misplace your private keys. Also, while gold has a heavily regulated market and stays pretty stable, Bitcoin right now is known for extreme volatility in a highly fragmented regulatory environment worldwide.
But despite that crazy volatility, we are seeing a massive generational shift in what people consider valuable. A 2019 survey by Edelman found that 63% of millennial crypto users already view digital assets as a better investment than gold during a volatile economy. This demographic shift is huge. When you think about the looming generational wealth transfer, these younger investors, who clearly hold a much more favorable view of digital assets, are increasingly driving the market narrative. It strongly signals that the demand for this unforgeable digital scarcity really isn't just a passing fad.
Section 4. The institutional tipping point.
So when did the big money actually start taking this seriously? If we track the timeline, a comprehensive academic study actually pinpoints October 2017 as the exact structural inflection point in the market. Before late 2017, Bitcoin and gold had a negative correlation. Investors saw them as totally different. Gold was for safety, Bitcoin was just high-risk speculation. But after October 2017, that correlation shifted positive. Bitcoin's price started moving in parallel with gold during financial turbulence, which meant investors were starting to treat it as a legitimate safe haven. Now actually, scratch that. It wasn't a perfect transition. During the COVID-19 panic in March 2020, Bitcoin crashed nearly 45%, failing the short-term safe haven test. But the broader trend kept climbing, eventually leading to El Salvador becoming the first sovereign nation to adopt it in 2021.
Following that shift, the market matured incredibly fast. Heavyweights like BlackRock and Fidelity, along with corporate treasuries at companies like MicroStrategy and Tesla, began actually integrating Bitcoin into conservative portfolios. They started recognizing it as a potential hedge against all the unprecedented global money printing and artificially low interest rates we were seeing. This era also brought vital financial infrastructure, like regulated custody services and ETFs. This finally allowed institutions to evaluate and hold Bitcoin using the exact same parameters they've always used for gold.
Section 5. Sovereign Strategic Reserves.
Let's escalate this from corporate boardrooms all the way to global governments. This is a powerful statement straight from the White House discussing the potential for United States digital asset stockpile. They explicitly acknowledge that Bitcoin has a permanently capped supply and has never been hacked, cementing its reputation as digital gold. The document essentially argues that, much like managing a vital natural resource, there's a distinct strategic advantage to being among the first nations to officially create a strategic Bitcoin reserve. That is an undeniable recognition at the very highest levels of government that Bitcoin is moving towards being a global reserve asset.
For central banks, holding Bitcoin acts like a unique insurance policy in a borderless, intervention-free market. Research shows it has unique investment traits that help central banks diversify against modern risks, hedging against inflation, capital controls, and even geopolitical financial sanctions. We've certainly seen how sanctions can freeze traditional central bank reserves overnight. And for countries like El Salvador, adopting Bitcoin was a strategic move to reduce their reliance on the US dollar, while also making global remittances way easier and cheaper for their citizens.
Section 6. Between promise and reality.
Look, as an impartial explainer, we have to balance all this incredible macro potential with the stark reality of the hurdles that still exist. Bitcoin is definitely not without significant friction. First, you've got extreme short-term price volatility. It can swing 50% in just a few months, which really limits its ability to be a consistent, reliable safe haven right now. Second, the massive energy consumption from its proof-of-work mining draws heavy criticism. Studies show the network uses as much power as some entire mid-sized countries. Third, the global regulatory landscape is just totally fragmented. Some places call it legal tender, others heavily restrict or outright ban it. That lack of a coherent legal approach creates immense uncertainty, keeping it stuck in this transitional zone between a speculative tech bet and a mature financial instrument.
And there's also a serious structural vulnerability that recent academic studies highlight. Bitcoin's decentralized security relies directly on mining rewards, which are tied to Bitcoin's market price. If the market price drops too low, well, mining simply stops being profitable. As miners shut down their machines, the network's computational hash rate drops, and that can actually undermine the security of the whole system, increasing the risk of a 51% cyber attack. This tight link between market price, mining incentives, and network safety is a huge challenge for its long-term stability.
Ultimately, all the extensive research we've analyzed tells us we probably shouldn't view this as a winner-take-all battle. Bitcoin hasn't fully attained the status of digital gold yet, mainly because of that wild volatility and the regulatory headaches.
However, the data strongly points to a gradual convergence in that direction. As the market matures, as narratives align, and as institutional adoption keeps growing, Bitcoin is evolving. It's maturing into a complementary store of value, getting ready to play a major role in the digital financial economy right alongside traditional gold, rather than just wiping it out entirely.
So we want to leave you with this final provocative thought. As global finance becomes more and more digitized, will Bitcoin eventually overcome its volatility and replace gold entirely, or are they destined to forever share the stage as complementary reserve assets? We would absolutely love to hear your perspective on this. If you found this explainer helpful for breaking down this massive economic shift, please hit that like button, subscribe to our channel, and leave a comment down below with your take on the future of digital gold. Thanks so much for joining us, and we'll see you in the next explainer.